Stop scrolling because what I am about to explain could change how you see the world's second largest economy and your portfolio. China is not crashing, China is not booming. China is engineering something called a slow bull. And if you don't understand what that means, you might completely misread the next global capital cycle. Stay with me because in the next few minutes I will show you why China is tightening regulations, how it's rebuilding investors' confidence, and what this means for global money flows in 2026 and beyond. Let's break it down. What is China's slow bull strategy? Here is the first big insight. China doesn't want a speculative bubble. It doesn't want a stock market crash. It wants controlled, sustainable, policy guided growth. After years of volatility from tech crackdowns to property stress, regulators are shifting turn. Instead of rapid stimulus and explosive rallies, Beijing is signing gradual stabilization. A slow bull means low volatility, controlled speculation, stronger corporate governance, capital market aligned with national strategy. What if the biggest opportunity isn't explosive growth but engineered stability? That's the game. Why did China tighten regulation in the first place? To understand today, we need context. In 2020 to 2022, China cracked down on big tech, online education, property developers, fintech leverage, major companies lost billions in valuations. Global investors panicked, but here is the deeper reason. China saw excess leverage, speculative bubble, data security risk, systematic financial threats. The government prioritizes long-term stability over short-term market euphoria. What if the crackdown wasn't anti-growth but anti-chaos? That changes the narrative of complete. The property crisis and financial stability reset. The property sector once represented nearly 25 to 30% of China's economy. When developers like Evergrande collapsed under debt, global investors featured a Lehman-style payment, but China avoided systematic collapse. How? Controlled restructuring, liquidity support to banks, managed defaults, state coordination. Unlike free market panic cycles, China slows the unwind. Imagine deflating a bubble slowly instead of popping it. That's painful but strategic. The message: no more debt fueled hypergrowth. Sustainable growth won. Regulatory shift from crackdown to calibration. Here is where things get interesting. In 2023 to 2025, the tone changed. Regulators began supporting capital markets, encouraging buybacks, improving disclosure standards, attracting foreign investments again instead of punishment. The focus is now transparent, stable, investable market. Is China rebuilding trust, not hype? Invest confidence isn't rebuilt with stimulus alone. It's rebuilt with predictability, and predictability attracts capital. The role of strategic sector. China's market isn't neutral. Capital is being directed towards AI and semiconductors, EV supply chains, renewable energy, advanced manufacturing. Companies aligned with national priorities get support. What if the real alpha is in policy alignment? China's model is different from the US free market style. Speaking of the US, compare this with the volatility seen in market like the NASDAQ Composite, where innovation drives explosive cycles. China prefers guided innovation. Two different philosophies, two different risk rewards profiles. Impact on global capital flows. Now let's zoom out. When China stabilizes, emerging markets feel it. Commodity exports feel it. Global supply chains feel it. If global funds believe China is becoming predictable again, capital relocates. Large assets managers, including firms like BlackRock, constantly assess regulatory clarity when deciding explore. What happens if global capital decides China is investable again? Trillions can move, but here is the risk. If regulations become too tight, growth slows. If it becomes too loose, bubbles return. China is walking a tightrope. The big question is the slow bull sustainable? Let's be honest, a slow bull market sounds boring, but boring can be powerful. Lower volatility means better long term planning, more institutional participants, reduces speculation excess. The real question is, can China balance political control, market freedom, innovation, debt reduction? If they succeed, this could redefine how emerging markets develop the capital markets. If they fail, volatility returns. Either way, this matters globally. Here is what most retail investors do. They react to headlines. Smart investors, they study policy direction. China's slow bull isn't about hype, it's about structure, and structure determines where long term money flows. If you want more deep dive breakdowns on global macro shifts, capital flow trends, policy driven investing, and trillion dollar transitions, then subscribe right now, because the next decade of wealth creation won't belong to emotional traders, it will belong to people who understand the system before the crowd does. And we were just getting started.